All right, thanks so much, guys. I guess just to quickly introduce myself, my name is David. I run two mortgage teams. We run Vision Mortgage Group and Vision Capital Partners. So I run that with my partner, Sue. So just a little bit of background about myself. So I actually come into this space through the wealth management space. And, my focus there for a long time, both in banking and in some boutique wealth firms, was really around helping people grow wealth and being very passionate about the planning aspect of wealth building and helping people, create their vision, create their plan and grow wealth. And ultimately what, I decided along the way was that I could help people grow wealth better through leverage than through traditional financial instruments. And that's really what spurred the partnership that I had with my current partner for quite some time. We'd known each other. Sue's a 30-year industry veteran who's been in residential financing for the better part of her career, most of it was Scotiabank. And we teamed up a number of years ago after being kind of business partners for a long time and created a team. And the singular focus of our team is really around helping real estate investors grow and create that vision for what it is that they want to achieve and be that one-stop shop that can take them the entire way. And one of the aspects that differentiates us within the real estate investing community, I believe, because I know there's quite a few investment-focused brokers out there, is that we have the capacity and the team and the skill set to be able to go right from helping people get into their first residential rental property, understanding how they can access high equity in their primary residence and take that step into real estate investing, right up to working with clients that are buying 100-unit apartment buildings and people that have 700-800 doors inside their portfolio, hundreds of which might be residential. And so understanding the complexities of large scale commercial financing, larger scale portfolio financing, and everything in between. And I think, for us, we end up with a lot of clientele that either, are lucky enough to start the real estate investing journey with us. Those that don't, I tend to find that we end up with them, through events like these, or because they've kind of outgrown their existing solution. So they've been working with a bank, they've been working with a broker who has been able to take them, a significant piece of the way. Maybe they have a handful of properties under their belt. But at some point that person says, look, I can't take you to the next step. And that's when they start searching for those alternative solutions. So Vision Mortgage Group is our residential division. Vision Capital Partners is our commercial division. And so that's really the way that we kind of split those different types of investors, and both divisions work hand in hand. Because many of our clientele need lending in both of those spaces. So what I really wanted to start with you guys today was, and this was kind of from discussions I had with Jenny Lynn prior to this, was around, what we can look at together, where are some of the gaps in, some of the presenters who may have been a part of your group before. What do you guys want me to focus on as a team to kind of talk you through? And the one thing that I want to say before I get into this, I created a very, very small slide deck here, mainly just kind of high level talking points, is I am more than happy to talk about anything that anybody here wants me to talk about. So if any of you guys have burning questions, some aspect of financing, that you'd like some commentary on, or that you'd like me to take a deep dive into, I'm more than happy to pivot into that. I do want this to be relevant, and I do want you guys to walk away from this feeling like you took something away from it that you really needed. But the high level conversations that I think I wanted to bring into this were understanding the nuances of building a residential portfolio. What we're really going to get into there is understanding scaling, understanding how do we make sure that you can still be approved for property number 9. And once you've bought property number 9, we can still refi property number 3 to continue pushing forward. Because I think, as people get through those first half a dozen properties, they usually start hitting a wall. And I want to be able to talk to, not so much inside technical sense, but kind of best practices and understanding what the different types of lenders are looking for and what are the important aspects of understanding the right way to scale a residential portfolio to continue to succeed. I did want to give a little bit of a discussion around introduction to commercial mortgages. I see that as something that more residential investors are migrating towards now. We are seeing kind of an exodus because the single families, the duplex conversions don't work the way they once did. we're getting into people understanding that, going with a 6-plex, going with a 10-plex, going with a 30-unit building makes more sense than trying to buy 10 triplexes. The lending makes more sense, the cash flows make more sense, the management makes more sense. And so I'll give you guys a little bit of an introduction to that. And then going into something that's kind of a little specialized combination of both, which is blanket mortgages. And what that really is how do we have lenders in a commercial lending guideline who can look at a portfolio of residential mortgages as a blanket. And they're looking at a portfolio of residential properties with a commercial underwriting lens, and how can an investor leverage that to do what we call a reset and allow them to continue to scale. So guys, feel free to unmute yourselves, stop me along the way, ask questions along the way as I go through this. Happy to make this interactive for everybody. So getting into the residential scaling, I think the biggest restriction in properly scaling a residential portfolio ultimately comes down to 6 key pieces of the equation. How many properties do you have? How many doors do you have? What order did you do your lending? What the rental income to mortgage ratios are on those properties? Who owns the properties, and what does the personal income situation look like? And I think everybody probably has some idea of how some of these different things play together, but I really wanted to walk through, what each of these mean, what types of lenders are looking at certain aspects of it, and what you want to focus on as you're understanding how you're going to grow and scale your portfolio. So property count and door count, same premise, different metric. So as I'm sure most of you have, probably understood it through your real estate investing journey, every lender has a limit. Every lender has a point at which they'll say, yep, this is as far as we'll lend to you. This is the total amount of properties that we'll consider. Some do it on a property by property basis. Some do it on a door basis. So somebody might say 10 doors, don't care how many properties. Some might say 5 properties, don't care how many doors. And so understanding the relationship between what each lender will do is a really important piece of that scaling. In addition to that, some of them distinguish a different level of door or property count based on whether you have residential properties held in a holding company. So some lenders might say, hey, we'll do 12 properties, but if any of them are in a holding company, we're only going to do 4, right? And so understanding the nuances of what that looks like really leads to the third piece, which is a lender order. So how do we decide who finances property, 1 and 2 and 3 and 4? Who do we use for 5 and 6? To give kind of a practical example, we don't use CIBC until you're at the end of your road, right? The reason we don't use CIBC until you're at the end is because CIBC will do 5 properties regardless of how many you hold with everybody else. Where most other lenders, when they're talking about how many properties they're financing, they're looking at a global property spectrum. They're not looking property by property with them. They're saying, hey, you already have 6 with Scotia. You're coming to me. Might be your first one with us as a lender, but really it's property number 7. CIBC is unique in the sense that they don't care what you have outside. They'll do 5. And so, CIBC might be somewhere we go once we have 10 somewhere else, and we can scale to a 15, residential property staying with the banks. And so understanding that lender order is super important. The most important piece for anybody who doesn't have outrageously high income is understanding the ratio of the rental income to the size of the mortgage payment that you're going to be looking for. 2 big pieces on this, I guess, would be to make sure that you're understanding the analysis on if I guess maybe I'll ask a couple quick questions. So is anybody here kind of scaling a portfolio through a BRRRR structure? Most of you?
I was, but then with the rising prices, we've gone to a lot of flips now lately.
On a BRRRR structure, one of the things that I think gets missed in this is people are analyzing what they're doing based on the mortgage that they get when they acquire the property. They're not analyzing it based on the mortgage they're going to want when they refinance at the after repair value, right? Golden rule depends on the lender. Every lender uses rental income differently and approaches it in a different way. But I think the general rule of thumb I'd say, and I know depending on where you're investing, this can be hard to do, rental income, double the mortgage payment. Most of the bigger lenders that we use for this, if your rental income is double the mortgage payment, that property will wash out. And what that means is that property is not going to negatively impact your ability to get the next one. And so if you can continue meeting that metric, what that means is the amount that you can qualify for when you bought your first rental, if you're on rental number 7 and every single property before that meets that metric, you have the same approval purchasing power on property number 7 as you did on property number 1, because you're having no net negative impact from all the properties that came before it, right? And the biggest mistake I see GTA investors make, and I don't necessarily know where all of you are based, if you're investing too close to home here, what's happening is those metrics are starting to spread way apart, right? People are getting into properties that aren't really cash flowing, they're net neutral, maybe a little bit of cash flow. And so what's happening is every single time they buy or refinance, they're subsequently eroding their next level of purchasing power. And for most of us that are on a, I'll say regular amount of income, if you have 100 or 200K family income, you can't afford to have 7 properties that are all negatively detracting from your ability to qualify, right? If you're making $1 million a year, well, maybe it doesn't matter, right? But for most of us trying to scale that portfolio, that is going to be before we get to property count, before we get to door count, before we worry about lender order. For 99% of our clients that we see hit a roadblock on that, that's the reason they're hitting the roadblock, is they've run out of runway for purchasing power, or they've run out of runway for refinances. We see people stuck at lower loan to values, lots of debt equity, inaccessible, because they can't continue to qualify at rates that make sense. The question that I got asked coming out of the podcast I did, I don't know if any of you listened to Sarah Larby's podcast, the question that got asked to me quite a bit was when I started talking about the blanket mortgages on that podcast and saying, hey, I can't qualify for residential anymore. Can I look at blanket mortgages as an option? And I think what I probably didn't make abundantly clear is the qualification for those mortgages uses the same metric. So while I can do that mortgage structure for somebody who's a professional real estate investor and has no personal income at all, I can only do it as long as the rent to payment ratios make sense, right? The debt coverage has to be there to be able to facilitate even doing that type. And really, at the end of the day, if you want to scale into the bigger leagues, everything comes down to your portfolio's ability to cover its debt. And as soon as you stop being able to do that, you're going to hit a wall. So that has to be a core component of your property analysis in terms of your growth capacity. The other one that we can play with, is ownership structure. And I think this one isn't used enough in terms of, especially for spousal couples, right? Everybody's doing everything together. They own the marital home together. They buy the first rental together and the second rental together. And what happens is we're basically taking up 2 people's limitations every single time we're scaling a portfolio, where we've been able to create some really great structures where we pick and choose who owns what based on each person kind of carrying their own property load, carrying their own debt load and their own income ratios, and allowing us to bypass some of the challenges around property counts, door counts, to be able to more effectively scale a portfolio, owning things individually than we would have been able to if they own them together. And then the last one is personal income. I touch on that mostly for those that are self-employed, because we do see quite a few self-employed people wanting to go down this road, and understanding that there is a inverse relationship between the amount of tax you pay and the amount of properties you can qualify for. And the biggest mistake that we see self-employed individuals making that are aspiring to scale rental portfolios is not showing enough personal income, right? They're writing off too many expenses as a sole prop. They're not taking enough money out of the corporations and dividends and salary. And they're going through this process where, the accountant is doing everything they can to save every penny of tax, not understanding that they're shooting themselves in the foot on the other side in terms of not being able to qualify. And so one of the pieces is, making sure when you're having those conversations and you're going through that process, everybody who's going to have a hand in your big picture vision and your plan, you're getting input from. So my clients around this time of year, my investor clients, they're going to send me the T1 generals that the accountant prepares a draft of before they file and say, hey, Dave, is this okay? are they allowing me to show enough income, or do we maybe need to, pull back on some of the expenses because, 2021 was a lower revenue year or something. And we can look and we can, map out what their game plan is and what they're looking to do. And we can understand if that income that they're going to be declaring is sufficient for what they want. And so that's part of creating that vision and creating that plan and understanding that, when you're doing this type of residential portfolio scaling, it is not sufficient to structure your approach property by property, right? It can't be we finish property 2, then we decide how we're going to do property 3. We have to have the entire vision from day one, because mistakes that you make on properties number 1 and 2 can be shooting yourself in the foot on properties number 5 and 6. And so if you don't have that big picture vision for it, you're liable to limit yourself a lot earlier than you think you might need to. Any questions from anybody on kind of scaling res portfolios and, best practices, things that you guys are finding challenging, things that I might be able to put some commentary on to help overcome?
I have a question.
Sure, go ahead.
Sure.
Because we just purchased a property in Niagara Falls that we would like for ourselves, like as a primary residence. And we have a property in Toronto, but we made the offer with both of our names. And then I said, wait, why don't we just use your name, my spouse's name? But then he'll need my name. We find that lenders want to pull everybody that they can, or maybe it's the mortgage brokers. They want to pull everyone they can to strengthen the application. So, I spoke to the mortgage broker and I said, why don't we just put it in Gladel's name? And she said, well, which is my niece, by the way, but she said, well, he may not qualify. So how do you do it in such a way where you can?
That's a great question. I mean, those that understand what they're doing, it's not a cut and dry. It is, let me rephrase that. It is a pretty cut and dry situation. So if somebody comes to me and says, we have husband and wife together, and they say, can we just use the husband or just use the wife on the title to this property? There's no strengthening or not strengthening the deal. Like if you're a broker and you know what you're doing, the deal either works or it doesn't. So if I run your numbers, with just the spouse, I'm going to tell you, clean cut, this either qualifies or it doesn't qualify. Or we're like, super tight and maybe we're a little bit in that tiny gray area, but we should have a pretty good level of confidence to say this either works or it doesn't. And if it doesn't work, then we come back to, okay, well, here's the alternative. So I'll have sets of people, whether it's spouses, whether it's, spouses plus friends or family members or whatever. I had a call today with a couple and then their friend that they invest with. And basically my ask to them was, look, I'm going to take everything I need from all three of you. And how about you let me structure title? I'm going to tell you who needs to go on what and what makes sense and what works based on everybody's personal situation and based on everybody's income. So if somebody, Susan, to your question, if somebody comes to me with like that and says, okay, well, can we just put one person's name? It takes us, for the amount of time once we have that application built, it's like 3 minutes to determine if I drop somebody out, does the deal still work? Yes or no? And if it doesn't, it's a quick answer to say, look, we do need both people's income. There isn't another way around that. But that should be a question that you should be able to get the confidence from your broker to have that person answer.
Basically, what I'm saying is that as much as it's nice to, as a couple, to maybe have 2 separate properties, it sometimes just doesn't end up being that way. And even if at the beginning they say, well, it looks like we can just have it in his name, it's the anticipation of, well, you might need to just get pulled in.
I love that comment. I think the most important thing, and I'm going to speak really broadly. The one thing I'll say, and this is kind of sidebar, but like mortgage agents and mortgage brokers as a whole is probably the lowest bar profession that I'm aware of in Canada in terms of what it takes to be licensed. It's a 5-day course. That's it. No prereq. 5 days, you write your 3-hour exam on Friday afternoon of the 5-day course, and then you're licensed. That's it. So you don't have to be very good at what you do to do what you do. And there's lots of great brokers out there, and there's lots of brokers that don't know what they're doing. Things in this industry, for the most part, should be cut and dry. There shouldn't be a, well, it looks like it works, but maybe you need to get pulled in. It should be, it works or it doesn't work. You definitely need to be involved in this or you don't. And there might be that very, very thin, area in between that it's like, look, we're asking for a little tiny 2% exception here. We can probably get it done, but there's a chance that doesn't work. But that should definitely be very rare that something's going to just slide so close to the edge that comment is going to be ambiguous. And you're absolutely right. It's not always going to work to have it in separate names, but it's understanding how you can optimize your situation as a couple or your situation as a couple plus extended family to say, okay, if somebody's going to take a look at the big picture here, how can we structure this best? What is the combination of people that we can put together that makes the most sense to do this? And not every family situation is going to be the same.
I'm going to just also make a comment because I found that really funny they said, because I've also had it happen where I was in a process where I'm just trying to get as many properties under me. And I found it really funny because brokers and lawyers were always like pushing me, we need to get your husband in there. And I'm like, no, it's mine. Or lawyers when they're finishing. So they're like, why did you do that? And I'm like, because that's what I want to do, And it was just like always kind of a struggle to, so I find that funny because I always found it a struggle. Like it was kind of like you always had to battle it out. And it's just like, I just want it this way, let's let it be. Let's just get it done.
It's easier, right? It's easier for everybody to not have to, run the solo model, right? So, yeah. If nobody has any other questions on res, I'll jump into a little bit of stuff about commercial.
I was going to ask a question for people that may be interested. I was thinking, because it kind of alluded to Susan's also, I know hers, she's talking about primary residence, but obviously talking back into rental properties. Let's say is there anything that people need to know if they have, for example, enough money, like a good amount of money, but let's say, like you talked about, let's say they're self-employed or their income isn't the best. Is there something that they can focus on or think about to help their situation more if they do have, let's say, that 20% down or something like that?
I think it kind of depends on the person. I mean, we have lots of products and programs that can mitigate, especially for self-employed people. They're probably the ones with the most options that if they don't show the kind of income they need to show, there's lots of products and programs, some stuff around stated income and using business bank statements to derive income rather than tax returns. There's a lot we can do there. For people who just don't have a lot of income, so, you're a pensioner, retired, lots of cash, but you make 12 grand a year. Not as much we can do in the residential space, but I think that's going to be a little bit of what I want to address on the commercial around the types of people that I'm pushing towards commercial financing, because not only do the deals make sense, for a lot of these people, the financing makes sense. And one of the things to understand when you're competing in a residential world, but you're not competing at residential rates, there's enough investors out there right now. You're going to have a tougher go of it, right? Because if you're running your model having to pay 4% and the other person bidding is running their model having to pay 2%, they can afford to pay more and make the deal work. And so you kind of end up in a bit of a shift where your numbers start getting tighter. And I think that's really where opening the door into commercial financing comes in, to say there's lots of ways to do financing for people that don't have strong incomes but have equity and have capital. There's just not that many people talking about it.
Awesome, thank you.
So jumping into commercial, commercial property types, traditionally, what I'm going to kind of focus on a little bit today is more geared towards multi-residential stuff. But residential properties with more than 5 units are typically considered commercial. Anything that has a commercial or retail or office component to it, portfolios of residential properties. So you have 10, 20 residential properties in a portfolio, and development opportunities. And so, these would be construction style, we're going to buy something, knock it down and build a building or build a set of townhomes, something like that. Qualification guideline for commercial. And this is really what's heavily different is the bulk of the qualification is going to be weighted on that property or that project's ability to cover its own debt. So we're not that interested in your personal income. And, you know, Diana, to get back to your point here, this is really where some of those individuals that are cash heavy can jump in and have something that can be a great investment for them without having to, you know, go through the expense of financing the types of financing that they may have to use. The more properties and experience you have, the better it is, the more the lenders like you. And that's very much the opposite in residential, where the more you have, the harder it is to get the next one. You do need to have some personal net worth behind you for these types of deals. It is considered. It's not always required, but usually is. You know, downsides, typically you're looking at 75% as the max loan to value, and typically you're looking at 25% as the max 25 years as max amortization. The exception to that rule is in the insured multi-res space, which is multi-res buildings over 5 units, where, and not to get into too much depth here, but I can go deeper on this if anybody's particularly interested. You know, there are programs for purchases and refinance up to 85 to 95% loan to value, and amortizations of between 40 and 50 years. And that's kind of a whole nother subset. And again, you know, coming into how this can work, it's a lot easier to go buy a 10-unit building and have a 85% loan to value loan on a 40-year amortization on one building than it is to go buy 5 duplexes and try and manage all of those in different locations in different areas. And so for people who really want to scale their door count, buildings can definitely be the way to go. You know, a little bit about debt coverage. So the way that these properties are qualified is based on something called debt coverage. So it's how is that property's ability to cover its own debt. So typically what we want to see is a 1.2 ratio. And what that means is we have $1.20 of free cash flow for every dollar of annual debt payment. So if we have if we want to qualify for a mortgage that has a payment of $5,000, we need to show $6,000 in income to do that, and not gross revenue, but net income after all the expenses on the property. And that's what's going to allow that to qualify and allow us to keep pushing forward. So I've built a little example here. This isn't any particular deal, but this is just a snapshot of like how we would, at a very, very basic level, build a model to analyze that. Would be, you know, we're looking at a property. It has $70,000 in annual revenue. We have these, you know, 4 expenses that we're considering. Now, there's quite a few more expenses that would go into it than typical portfolio, but just for ease of calculation, which brings our expenses to $13,000. Gives us a net operating income of $57,000. Then on the other side of the equation, we're hoping to qualify for an $800,000 mortgage, amortized over 20 years at a 3.5% rate, gives us a $4,000 monthly payment or a $48,000 annual payment. We put the net operating income over each other, and what we see is we have a 1.18 debt coverage, which means we're probably a little short of qualifying for the entire 800,000. Not to say we can't get some exceptions or find some ways to mitigate that small shortfall, but it's close, but not quite there in terms of what the typical lenders would want to see to qualify that. That is the basis of commercial underwriting. At a very simplistic level, this model would still apply to somebody coming to me and saying, I have 100 residential properties. Can you give me a mortgage across all of them? At the base, it is still the same model. And so this is why having the cash flows and not relying purely on properties that have equity upside, if you're trying to build a portfolio, that's why it's important, so that you can continue hitting these numbers and continue hitting this model time and time again, to be able to continue to re-leverage what's inside your portfolio. Any thoughts or questions on commercial lending?
I just want to know if you could go back one page for me. So I'm just writing stuff. Yeah.
1.2 is a threshold. Again, general number. Every lender's got a little bit of a different requirement. But.
Yes. So I guess you were talking about the section of the expenses, and you said there are more. So what should people make sure that they have when it comes to commercial lending? Like, is there anything else? Because you said there was others. What should we be paying attention to make sure we have in our list of things that are expenses?
I'll say this as a blanket statement. You shouldn't be doing it yourself. And I think that's where, the partnerships with the people, because that list is different for every lender, right? And somebody who's not experienced in this can, I don't want to say get yourselves in trouble. Like, it's good to have a good idea of understanding how to analyze these things. But, when we're working with our clients that we work with on an ongoing basis, that is part of what, we do, which is somebody's going to run a property by me and say, hey, Dave, we're thinking about putting an offer in on this one, or we got this one conditionally under contract for 3-4 weeks. How do you feel about these numbers? What do you think is realistic? How are we going to play this lending process? And, when it comes to commercial mortgages, everything is custom credit, right? This is a very basic example, but everything we're doing is going to a lender and pitching an idea or a concept. And usually, there's actually 2 different pro formas that go out. There's the as is and the as complete, because we're probably buying something that's underperforming and needs rehabilitation. We need to move the under market rents up to market rents. So it's like, here's what we're buying. Here's what it's going to look like when we're done. Here's the cost and the timeline for us to execute this. We need some sort of acquisition financing blended with some sort of construction financing terms so that we can finance both the acquisition of it as well as the renovation project. We want interest-only payments for the first 18 months because that's how long it's going to take us. And then after that, you can move to a blended payment. So all of that type of stuff for us is the custom credit. It's you coming to me saying, hey, Dave, here's what we're thinking of buying. Here's how it looks today. Here's what our plan is for what we're going to do with it. What kind of lending package would make sense for us to proceed with? And then we would put all of that together based on the lenders that we think we're going to use, or we're going to underwrite it the way that we know they're going to want to see it. And then we're going to be able to tell you, okay, maybe we're going to be 75% loan to value on the acquisition for this one, and we're going to get you 80% of your construction costs covered. So you're going to need 25% down and 20% of your construction float. That would be the typical model that we would go through in this process and work with people as they're going through their acquisition within their commercial portfolio to understand what that looks like. And it's a much more customized world. It's a little bit more of a complex environment because it doesn't follow the same cookie cutter mortgage approval routes that residential financing covers. So, this is where we see more gray area. This is where there's a little bit more of a subjective approach based on how we're pitching it and who we're pitching it to, and how they're feeling about, feels on that particular day. Because they don't have that same cookie cutter methodology that the residential lenders do.
Thank you. And I just want to clear up. So the annual revenue, just to make sure that everyone, I feel like, is the annual revenue of the building itself, right? And then obviously the mortgage and everything is related to the building. So this is all related to the building. So is because you said that there is a portion that it's still, they will consider us. There's a portion of it or percentage that they still consider our personal income. How
they don't really, it's not considered, what's the best way to put it? It's not mathematically considered, right? So when they're looking at who's borrowing, it's not like a residential lender who's going to do specific types of debt ratio calculations with your income and your debt load. And, if it's above or below a certain threshold, you're approved or denied. It's more of a reasonability test. It's like, who is this person? What kind of experience do they have? What kind of net worth do they have? What kind of income do they have? I've gotten $10 million mortgages for people with no income. And that's because the deal still made sense, right? They were professional real estate investors. They were people who had, tons of equity, tons of net worth. If you have no income and you have no net worth, and you've never done a rental property before, just because you can meet, these guidelines doesn't mean a commercial lender is going to approve you. Probably not. There has to be some rationale, but I guess what it means is they're accessible to doing lending for a broader scope of clientele that don't necessarily fit a cookie cutter debt service calculation, right? So it's part of our job to kind of pitch and help them understand the story behind why it makes sense to lend to this individual, A, and then B, why does the deal in front of them make sense, and why does it make sense for them to proceed with the credit request that we're putting forward. So there's not a mathematical piece to it. It's really just a subjective piece and a reasonability test.
Mm-hmm. Yeah, great to know. And
so talk a little bit about blanket mortgages. This runs off the same premise as what I just showed before. But in this is where we're not looking at a commercial property. We're looking at a selection of residential properties. So we're going across 5 or 6 or 30 res properties that are single families, duplexes, triplexes, but we're applying the same underwriting principles to them and saying, you know, hey, does this portfolio meet the guidelines that it's required to meet to lend against? Again, not really counting your personal income. So, you know, in the case of going through this process, let's say I have a client, they have 10 properties in a holding company, you know, all of the loan to values are pretty low because they've been, you know, holding on to them for 6 or 10 years. They're ready to refinance, but they don't have enough income to do so, but the properties on a cash flow basis all make sense. You know, or maybe they're just tapped out with the residential lenders. They want to buy more, but they've kind of hit their threshold. We can go through this process and do a blanket mortgage and sweep all of those residential mortgages, replace it with a large commercial mortgage. And that really accomplishes 2 goals. Number one, that allows us to refinance for somebody that might not otherwise be able to because of their personal income, as long as the properties make sense. But number 2, it can give us a bit of a reset button where now, because the residential lenders don't consider commercial mortgages in debt service calculations, that person that has 10 properties under their belt is now going back to their bank for property number 11, who's treating them as if all they own right now is their primary residence, right? Because we've taken the entire existing residential portfolio and moved it into a different lending segment, and the residential lenders aren't looking at it. And so it's a bit of a way of hitting the reset button to say, hey, we get to do this, and now we get to start over at property number 1 again. No, you know what? It's something that I think a lot of people, and there's lots of other types of special programs like this and different unique avenues that we can go down. And I think ultimately it really just comes down to helping each investor understand what kind of road they're going to need to go down to hit the vision that they've set for themselves. And everybody's going to be different. Every group of investors is going to be different. It's all going to come down to having somebody who can give that breadth, you know, give that guidance to say, based on your situation, here's the path that you know, you should follow to continue to be successful. And you know, for us, it really comes from getting to go through that experience of watching people grow these portfolios and watching people achieve their goals and hit what they set out to hit. And that's a big reason of you know, why I decided to make the change here and why I decided to move into this side of it. You know, as a bit of a backstop, I'm quite heavily invested in this space myself. You know, myself and my partners and my wife do a number of residential stuff, multi-res stuff, larger buildings. So we do a little bit of everything ourselves as well. I think it's important, you know, for people to understand that this isn't something we just preach. Like, this is something that, you know, myself and my team is actively doing on a day-to-day basis in our own portfolios as well. Went through a little bit on the blanket mortgage side and kind of its application around using those same commercial guidelines to really just apply that same theory to a portfolio of residential properties instead of a single commercial building. You know, so looking at a 20-unit building, we can apply those same principles to somebody who owns 10 duplexes, and do that same type of lending across a portfolio rather than isolated to one building.
What type of lender would that be? Would it be like a credit union or a bank does
Credit
that?
unions, banks, most of them, to be honest. Not all of them, but a lot of them do. But it's all about, you know, and no different than anything else in some of these mega lenders. It's all about, you know, sitting in front of the right arm. If you walk into a, you know, BMO branch and ask the branch banker that you'd like a blanket mortgage across 15 of your residential properties, you'll probably get a blank stare. You know, it's having the right, you know, some of these institutions are monstrous, right? And they have all different divisions that do all different sorts of specialties. So part of that process is kind of having the right people and knowing the right people within each of these divisions to understand who does what and getting your deals in front of the right person.
Thanks.
I have a question. Sorry.
Sure.
So I work for Scotiabank and I'm the senior financial advisor out there. When you mentioned that, yeah, if someone comes to me and asks me, you know, if you like, if they want a blanket mortgage, I'd be like, what are you talking about? Which language are you talking about, right? So you're absolutely correct. Like, if you go to a banker and if you say that you want this product, it will be like, they won't know about it because I don't know about it. I've been in bank for like 5 years now and I do mortgages. And forget the blanket mortgage. If a client has more than 4 properties, we'll be like, oh no, now this is going to be a lot of documentation work, because those people in the bank, they not only deal with mortgages, they do investments, they do, day-to-day banking, they do a lot of, things together, as compared to a mortgage broker. They are only focused in mortgages, right? So that's a good point you mentioned. And I was just wondering, working in Scotia, I've seen a lot of brokers who do mortgages, but they don't do it as a home line. They do it as a straight up mortgage. And I wonder, like, wouldn't the home line be beneficial for an investor to take out more equity, like take out more money from the line of credit as the mortgage is paid down for future renovation?
Yeah. So I guess a couple of things on that. I'm not going to get too much into the intricacies there. I think the biggest thing on the broker side, and I mean, I think you brought up some phenomenal points, by the way. Thank you for that. Like, brokers are not going to have the same training on the power of the STEP program as you do, right? So when you look at a STEP, you immediately identify an understanding like how that's incredibly valuable to a real estate investor, right? And we can add the multi-component structure. We can do the multiple mortgage components. We can do the lines of credit. We can kick them back to the branch for, overdraft or credit cards, or tie in, sole prop businesses to it. Like, there's so much you can do with that product. When they bought out National Trust and John Webster took over Scotia Mortgage Authority, what Scotia has created in that product was most of the banks have some iteration of it at this point. Not all of them do, but most of them do, mainly BMO and Royal. It was the first and the best in what it was, and I think it still continues to be. But the broker is not going to have that training to understand that, right? Most of them are here to be transactional. They're here to do your mortgage and move on to the next deal. They don't understand the implications, or they don't care to understand the implications of what's coming next, right? And so I think that's the difference, and no different than having a number of different financial advisors at Scotiabank. I could run the gamut of FA6s in Halton Region. I probably know most of them, and pick out the 5 of them that know what they're doing, and the other 60-70% that don't. It's no different in the broker world, right? Some people just know what they're doing and some people don't. And for a lot of clients, it comes down to the luck of the draw of whose lap you landed into, and who you stood in front of. I've run the gamut at Scotia. I probably hold almost every role you can hold in a branch. So when you go through that process, you go through it with somebody who understands that, which means myself and my team. I think between myself and my partner, we have 42 years of combined Scotiabank employment. We probably, as brokers, understand that product better than anybody, but most won't.
Right. Yes. Thank you.
Yeah, but very good point. Like, Scotia Real Estate Division would do blanket mortgages, right? But as a branch rep, you guys probably would have never interfaced with them ever.
Yeah, and I've been working for Scotia like just 3 months now, been with RBC and TD before. And I think Scotia is the only bank which offers this product, not like the STEP product, as compared to RBC and TD. I think Scotia is way better. Yeah,
RBC has got something kind of similar. TD has got something kind of similar. CIBC's is not nearly as good, but Scotia's is certainly unique. Yeah, and they would probably be a go-to rental lender for the first, dozen, or at least 10. Scotia would be a very competitive. They are the most generous rental lender in terms of their calculations.
Yeah, thank you for sharing that.
Yeah, I'll take the last question just because I do have to actually run a date, unfortunately. So this will be my question. Could you briefly elaborate on some of the things that you look at on the lender side, or from the borrower when it comes to commercial? I know generally commercial, you're looking at the asset. It's more asset driven than it is borrower driven. But I mean, you do look at the borrower's profile.
Borrower, I mean, if I was to really sum it up in like 3 words, it's income, net worth, and experience. those would be the components, quite frankly, is, what do they do? How are they generating the day-to-day income? How significant is that as a, part of their picture? How much do they own? What's the split between real estate versus liquid and investable assets? How much liquid backfall is there? And how many times have they done this? Is this something that, they've been doing commercial investing for 2 decades and they have, 100 properties under their belt where they've churned through? Is this something that they have a portfolio of, 8 or 10 res portfolios and now they're ready to dip their toes in, or are they trying to do commercial on their first ever deal? And as a one further extension to that, if some of those gaps are missing, specifically on the experience piece, who are their mentors, right? I've literally had lenders ask me for a list of a client's mentors and coaches to understand who are they getting their support from, who in this industry, who is recognized and who does have that experience for a newer investor that maybe can't come to the plate. How are they going to continue to be able to accomplish what they need to accomplish? And there's a whole bunch of ways we can support that.
Interesting. Okay. Fair enough. I
Awesome.
sent you a direct message too, by the way, David.
Yeah, perfect. I will shoot you a message back. I think, Danny, you'll probably share my contact details at some point, pass it along.
Yeah, we'll be
Perfect.
sharing his contact details, so you guys will all get it if you guys want to talk to David and just ask the questions you need, or obviously work with him. He has a lot of awesome experience and very many different niches. Because I just make a random comment is that I think people find it funny that I have many different brokers, and it's because I have them for specific things where I know specifically, like, oh, this is what you do, I need this, I'll use them for that. You do realize how important it is to have that person actually understand what it is that you need. If you know what it is that you need, making sure that that mortgage broker knows how to explain it or how it works or whatever it is. Because like that, if they don't, then it's just like either you may get a product that you're not really, it wasn't exactly what you needed, as you were stating before. So it is very important to have someone that knows, what you need.
Yeah, absolutely. I couldn't agree with that more. You don't want to be trying to fit a square peg in a round hole in this industry. But yeah, guys, really appreciate you jumping on. Appreciate the questions. Happy to take the time if anybody has any deals they want to have a chat about. Always happy to have a call and have you run something by me.
Awesome. So thank you.